Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. I'm sorry. I completely lost myself this morning. I knew I needed to come in here early so that we could see that CPI number. By the way, I'm not getting the month-over-month number yet. What's with that? But I was reading something on TikTok and I was replying to the thing on TikTok and then I forgot. Oh, right. Yes, we need to start the stream. So I feel dumb, but man, big pop off of that. And then it came completely back. Show me the month-over-month number, please. US CPI month-over-month, spot 2 versus spot 3. I need that core number. Give me that core number. Let's see here. Jobless claims, actual 224 versus 225, so that's pretty close to in line. PayPal says it's 1.5, 1.15. Oh, yep, I got it now. 1.15. Wow, that is actually the biggest beat on CPI I think I've ever seen. Is it? Yeah, 0.159 versus an expected 0.3. Which is kind of weird. Did they start releasing the number to 3 decimal places? Because it was always only to 1 decimal place, and Goldman would always give it to 2 decimal places, and I was always like, well, why did they do that if the actual thing is... Okay, but 0.159 versus 0.3, that's half almost of the expected CPI on core. That's a good beat. But more so than that, year over year core CPI, 2.6 versus the expected 3, and then the headline CPI 2.7 versus the expected 3.1. Those are all very good numbers. Those are all, you know, inflation is going to normalize. Maybe the Federal Reserve really can continue cutting in March. I think so. You know, going to like the longer term, what's going on here with treasuries and everything. Well, interest rates are too high for many sectors of the economy. For instance, housing, we would really need we really need the interest rates to come down to help the housing market, for instance. Well, how are you going to do that? If inflation is at target, if inflation is at 2%, and then you usually want to have 1% on top of that for yield, so you're giving them 3% yields, that's not enough. That's not enough for the housing market. That's probably not enough for the tech market because we're almost already to 3%, right? How do you deal with that? You would have to have inflation start running under target. Well, there are some reasons to think that maybe inflation could run under target because AI is an extremely deflationary force. And, you know, we've kind of lived in a generational low inflation environment, one where Federal Reserve has to continue printing money to keep deflation from happening. These numbers kind of suggest that things are normalizing more quickly than we thought, and that maybe that means the possibility that we go back into a deflationary environment becomes strong. You think maybe? And yet, we popped off initially and completely retraced it. So I'm not sure what to make of that. It might mean nothing. It might just mean that the traders took the knee-jerk reaction and then took their profits. Goodbye for the year. We're done here. You know. So I was watching this TikTok. Very interesting because I can tell. So for those of you that missed the story yesterday, came across a TikTok from somebody. I think that they're some sort of a fund manager, and they were making an argument about order flow. That honestly, like the words, like what he says in the TikTok, don't really make much sense. Like he's making some argument that I don't think anybody has the context to know what he's arguing is really what I think it was. But it was in response to a question about, well, like, what about trading order flow? Like retail traders that trade order flow. He was saying like there's nothing embedded in the price, something of that nature, right? So he might be making a different argument. I said, well, order flow does provide short-term predictive signals. Keyword short-term, right? The really predictive signals that we get in order flow are very short-term, which means it might tell you about things that are going to happen in the next few seconds, right? So I responded to him with, a couple of studies we talked about. Maybe he just doesn't know anything about them. And so he was talking about the studies. Again, well, to me, it feels like goalpost moving, but it's probably not actually goalpost moving, right? It's probably just we don't really understand the argument that he's making, and he's ignored my argument, right? I said, well, it provides short-term predictive signals. He just ignores that and moves the goalpost, right? But one of the things that he was saying in there that is absolutely true and extremely key is that all orders have the same impact, essentially. So it doesn't matter if you're trading it because you think that inflation is going to start running under target, or you're trading it because you have to rebalance your fund before the end of the month. The impact of the orders is the same. So you can't just look at the order flow and assume that there's informational content in it. I mean, he didn't say it in those terms, but I mean, he's hitting on that. That's something that we get, like a conclusion that we come to from the literature that's super, super important. All of the orders have impact regardless of why they are submitted. So, which is why what we're doing is really trying to predict the future orders. If you just come in and you say, I'm going to predict the trajectory of the economy, and then I'm going to make short-term day trades from that, it's not going to work for you because you have to predict the orders, and the orders can contradict that sometimes, right? So when we're looking at a move like this, we want to think, because we've been trained by technical analysis, which is false. We want to think that if we moved up and then came back to where we were, that means that this CPI news didn't mean anything. That's not necessarily what it means. What we got from CPI could be very, very significant. It could very much change the opinion of, future expectations of inflation. It's just that didn't cause orders to come out because they were already positioned that way, or we're about to go on a holiday, and so nobody really wants to be putting on a whole lot of risk, right? That said, on a move like this, it's pretty common to have like the initial move, and then after things calm down, some of the bigger fish kind of come in and start executing. So I think that we should still be on our toes for something to happen here. Yeah. Okay, so anyways, and again, I apologize. Like I was reading in fact, I kind of want to go back and look at it again and see if I can figure out what the hell he thinks he's talking about. But I just completely forgot because I was already I would have been here at 6:25, but then I started typing something out. Is it ADHD? Well, what else do we have? Oh yeah, you know we should come to the volume profiles. What we should do. Okay, well, so the treasuries were up a decent amount overnight. Like I think if we ended the week here at 24, pick the round number, okay? We ended here at 24. I think I would be happy with that. Because it was really, well, I would prefer to be up in this area, right? But it was like kind of everything after this big drop right here that I was kind of like, I don't know. And we'll talk a little bit more about that in a second. S&P 500 got slaughtered yesterday. We can go and pull up the Oracle chart. I think Oracle had a lot to do with it because Oracle had another really, really bad day. Man, it's like, it's another one of those things where it's like, I feel like it's doing stuff because I'm looking at it that I've never hit to notice a tendency for, like, as soon as I start looking at a stock, then it starts doing that doesn't happen. It's really, really unusual for me to be like, okay, this is a stock that I need to start paying attention to. And then it's just like down every day, day after day, bad news. It's just, I've never seen it quite that bad. Well, and maybe it is just an unusual situation, where one stock has such a big impact on the market, but it is wild to watch, and the S&P 500 definitely took a dive yesterday in part because of that. Okay, oil. So on oil, we recovered the 56 yesterday because maybe the world isn't going to have peace, but they're just kind of ranging around here now. So I think there's still a little bit of fight in this thing. Gold and silver. Well, gold looks pretty good. They're kind of like on the precipice of pushing new highs. Silver had another big breakout yesterday. And I mean, it was a real big breakout. That's crazy. So silver is getting crazy. It is. I still kind of feel like it should be higher, but I don't know if I really have a good justification for that anymore. I do kind of think that, like, I think the reason I'm hesitant, like, I think I made a good call on silver, but now it's like, oh, you made the trade. Didn't get as much out of that as I maybe wanted, So, but I'm really questioning if that can really go much further. I don't think that it's going to collapse. Probably at some point we're going to get another thing like we got in the beginning of October where they came back and they had a pullback and everything, right? But I think that gold and silver are probably going to be doing well for a few years. Kappa going sideways here. And the Japanese yen down again, although popping and did not retrace as much as the treasuries did on the US CPI news. And then we got Bitcoin. Well, it's there's a little bit of a buy here this morning, but they're still kind of struggling. Yesterday they had a bit of a jump up and then they got cut down. So, let me see here. before I get into other stuff. Yeah, I read the chat here. Every comment. Okay, so we got to, I don't know, do you have a question? Because if you got a question, we should do that first before I get into the next thing that I want to talk about. Also, I didn't say hi to everybody. Welcome back, Kevin Hawthorne. Hey, Paul, Andre, Rox, Belligerent. What was Belligerent's name before? I forget. Have too many questions? No, go ahead. You know what? I really like questions. You know what I don't like is questions that show that you either didn't understand or didn't take to heart the things that I said before. But since you haven't even asked your first question, I think you're totally in the clear, right? Well, I give you some time to type something out, but I want to come over and talk about this zero hedge story. Do they still have it pinned? Yes, they do. JP Morgan is the bank behind the repo crisis and the Fed's decision to launch QE Lite. Well, it is a premium article, so I'm not going to read it to you guys. But basically, the gist of it is they talk about the repo crisis. I mean, really, we've had 3 now. There was the original one back in... What, has it been 3? Yeah, there was this original one back in like 2018. And then we had another kind of like more different thing happen just before COVID. And then we've had something more recent. And Zero Hedge is essentially saying that the reason that is happening is because JP Morgan ends up making big moves in the treasuries, and that ends up draining all of the liquidity because they're so big in that market compared to like all of the other banks. Now, the reason this is interesting is that in late 2019, we had this going on. And so the Federal Reserve basically launched what we call QE Lite. So they're not doing real quantitative easing. They are just creating this repo facility and making moves in the short-term, overnight funding market, essentially. And at the time, we started to see the treasuries move up. In fact, during that time, we saw some of the highest liquidity in the 10-year treasury that I ever saw, where we had some weeks where we had 10K in liquidity at every price. It was really wild. And they were buying up treasuries at that time. And so some people said, well, this is because of quantitative of QE Lite. And some people said that the market is predicting a recession or something bigger going on here. And there was a great debate about what maybe it meant, which I always kind of come back to this, well, you shouldn't read a change in price as necessarily informational content, right? We know that that's not the way that the market works. But I really wanted to see how it turned out because in particular, I was like, does this actually lead to a recession or predict a recession? And then COVID happened. So some people will argue that like the treasuries knew that COVID was going to happen, but I think that that's ridiculous. Nobody knew that was going to happen. So I don't think that that's what that flow was. But basically, because of COVID, we never really got the answer to that question. And now we are getting it again. We're kind of getting this behavior again now maybe this time around we see where it leads. And I do kind of think that it leads to higher treasury prices. But we'll see what happens. Okay. Do you code different strategies based on the regimes you are in? How can one backtest these strats without enough coding knowledge? Okay, that's a really good question. It's a really good question. And I think you are hinting on something that is a little bit beyond my experience, at least. Because we've written a lot of strategies where we can see, like, there's good theory behind them, and we can see in a certain market that it does work very, very well, but have been unable to find any kind of metric that you can latch onto that effectively reflects when you are in that regime and can be used as a filter for when you do and don't want to use that strategy. The only one that I've really been able to find and have success with is looking at volatility itself. So, like, if I just look at a 14-day ATR and then I change how I trade the strategy based on where that ATR is, I've found that to be effective in many instances. And usually that means, by the way, that when you get into the volatile regime, you just don't trade. Okay. But there are other regimes where we can definitely see it. You know, like there was this time where buy the dip was king. I mean, I think you still do okay with buy the dip, but there was a time when buy the dip was just the best strategy to use. And I remember at the time, a lot of people, like, we're talking about this on the stream all the time. Oh, so we should just buy the dip all the time. And we said, well, no, because at least for us as short-term traders, eventually you get into a regime where that just gets you absolutely destroyed. And when is that going to happen? And it did end. It did end. Kind of COVID happened, and then there was a period of buy the dip and after COVID, and then after 2022, kind of changed. So, what can you latch onto that says we're in the buy the dip regime or not? I do think that there is some more advanced statistics and machine learning that you can lean on for something like that, where you can pass a bunch of different data series and it will figure out if there's a way to detect the regime. But I haven't been able to do it. So the word cap is aggravating sometimes, especially for certain conversations or arguments. It really is. You know, if we're getting into something like that, though, probably what you should do is just go into Discord, right? Just go into the free Discord and go into the main channel, and we can go back and forth in the Discord. Yeah. Okay, so there was a couple of other things. Rox was saying, I wonder if gold and silver may run into trouble here because most bulls are speculating that inflation will run hot, and it's not. I think the trade relies on the Fed cutting too much and real yields going negative. That's a good point. But you know what? I think it's actually more than that. China in particular has been accumulating gold and silver. And I also think that a part of it is that a lot of the demand for silver and gold kind of went away because people were buying Bitcoin. And now that's not happening anymore. And so some of that demand is coming back and pushing them up. So I don't think that you necessarily have to have inflation for that to become a problem. In fact, if we were getting data points that said inflation is a problem, like if this was instead of a 0.15, it was a 0.4, right? So inflation is a problem. Probably gold would sell off on that, similar to the way that it did during the first inflation bout. So I would say it is a risk, but I don't think it is the only thing going on pushing gold and silver up, right? You notice that Archive Is doesn't work anymore, and if you try to open the premium links, it shows you this is, oh yeah, like I think too many people got caught by Archive, and they've been trying to take it down and or limit our, it doesn't have the same support that it used to, and so they can't provide the same service that they did. Okay, Lang. Would you still use market profile as context? What is the most efficient way of identifying a trend as a scalper? So here's the thing. Ultimately, market profile is really like a solution looking for a problem. So basically what happened was these guys in the 80s, they said, hey, we could organize the data as how long it spent at a certain price or how much volume occurred at a certain price and look at it that way, as opposed to just looking at price over time. And maybe there's some interesting stuff that we can discover in that, right? And almost immediately we did discover that there's a Gaussian distribution there, which kind of doesn't really make sense if the markets are purely random, right? Well, there's reasons why that happens, but they formed a theory about why that was, and then retail traders kind of ran with it. Okay, that auction market theory was fundamentally flawed. So now you're kind of coming back and saying, well, okay, so if the auction market theory was fundamentally flawed, can we still use market profile? Maybe, but I kind of feel like that if there was something in there that was really, really useful to us, that in the last 30 or 40 years or so that market profile has been around, that there would be some really solid research about it. And I haven't seen that research. So I'm not going to say that you can't dig in there, but I personally don't have any reason to believe that market profile is going to be super effective for you. Now, I do still find the volume profile that I have up on my DOM useful, but only because that gives me the numbers about how much is traded in a location. Like I know 3K is your average standard sized iceberg order. If we get an iceberg of 5 to 10K, that's kind of a bigger one. But then if we move to a spot and then, we're starting to get into the 30 to 50,000 contracts that have traded in an area, right? Like that's how much we'll end up trading in there over time. So it kind of gives you some ideas of how big the orders really are. So watching the volume profile as it develops is something that I do want to see. I am trying to identify liquidity holes, areas where prices kind of going to get stuck. And I want to identify it early. So I'm going to see a spot where, too much executes all at once, or they just completely skip over a price. And that's going to be something that can often cause a liquidity hole, right? So now from there, I'm making the prediction, we're going to get stuck here. If I'm correct, you're going to see a lot of volume trade there. So that's where then I want to see that Gaussian distribution form. Again, the pattern is the result, not the signal, right? So the distribution is not normal in most of the days though. Well, there's like double distributions, but like a completely disorganized distribution is highly unusual. Yeah. What papers have you found really useful? Well, I mean, I really think that you go back to the book, the Financial Markets Under the Microscope book, because that's really like the foundational, information. But I think the thing that's most useful to us as retail traders is the understanding that all orders have impact, regardless of the informational content behind them. And what that results in is essentially a market that is extremely efficient on a short-term time frame and extremely efficient from a statistical point of view. You come in and you do a statistical analysis of the price. There's hardly any information that you can glean from it that predicts future price on short time frames, at least. There is momentum as a thing. That's a different thing, right? But if you were to say, does the current price reflect all available information? That is informational efficiency. The market is not informationally efficient at all for the same reason. Because if we were at the most efficient price, but then somebody comes in and has to buy a ton of it, not because the economy changed, but just because, they tripped or something, it still has an impact. And the impact is permanent too, right? So that's, I think, the most important takeaway for a retail trader. The market is statistically efficient. It is not informationally efficient. Now, unfortunately, that's kind of makes it difficult for us on both sides, right? It would be better if the market was statistically inefficient and informationally efficient. If the current price reflected all available information, but if there were patterns in the price that were really easy to, right? That is essentially the paradigm or premise that most technical analysis is running on. The current price reflects all available information, but it's not statistically efficient, so I can still take a short-term trade and make money from it. Okay? If that was the case, then everything about what retail traders talk about would be true. You would just have to learn a couple of patterns, you can make money from it, and nobody would have any reason to ever do anything, any kind of real work in the world other than just to trade. And everybody would be a day trader, and we'd all be millionaires from following these patterns. Similarly, if, both things were true, if there was, the market was statistically efficient and informationally efficient, then there would never be any reason to trade ever at all. And the entire financial industry would cease to exist. So really, it's having a market that is statistically efficient and informationally efficient. It's kind of necessary for the market to function. You think about it. These guys, the market exists for those people that have the money and that have the information to come to the market and to be able to profit from that. If the market wasn't basically noise on that short time frame, then anytime that they did anything, we would all be tipped off to it immediately, and then they wouldn't be able to trade because we would either completely front run them or just pull all our liquidity, and it would be impossible for them to do anything, right? So it has to be statistically efficient and informationally inefficient. But again, the downside of that is it means trading is very, very difficult. But it also suggests something for you as a retail trader. There are a lot of things that you can look at that are useful and help you. Order flow is one of them. I really don't see how you can be effective short-term trading without watching the order flow, because without the order flow, you don't really understand what's going on. But again, the signals that you get from order flow are short-term. So you need more than that. And where does that come from? It comes from the informational inefficiency. So what you know about the market, the situation, all of those things knowing that today we had CPI and that the CPI was going to be kind of a big deal because we hadn't gotten a CPI in 2 months, and that people are concerned about inflation rising because of tariffs. So a low CPI number would be really, really good. But then also knowing that this is basically the last big data point before the Christmas holiday, and that the markets are going to kind of go to sleep here. All of those things together are things that you can use to predict what the orders are going to be. And then you watch the order flow and see if that's actually happening, and you know, pick your spots, right? And that's going to be the most effective framework to help you. But I'm getting really, really deep there because, like, that's what you have to know to put it into practice. But if you really want, like, what is the high level, you know, catchy explanation of it that's just really short, is trade the news, right? Because the market is not informationally efficient. That means that there is going to be news, things that you can know that can predict what's going to happen all the time. It's just that you might be 100% right and the market still ignore you, right? So it'll still be hard. But there's more edge to be had in the informational inefficiency for us, right? That's the most important thing. That's why I've been getting a lot of, well, okay, what about market profile? What about this tool? What about that tool? I mean, I don't want to tell people, you know, don't bother studying these sorts of things. Like, there's always, if you're doing an empirical study of it, there's always value in that, if only for the experience of knowing how to test things, right? And testing things that there isn't really anything to is useful, because a lot of people get fooled by those things. They don't know how much data that you need and the kind of tools that you need to really see if there's something there, right? But at the same time, knowing all of that, why would we be really interested in, should I have the RTH session or the ETH session up on my volume profile? I have it up there. Who cares if it's RTH or ETH? I really don't think that it changes anything, right? What really matters is, like, the most important thing right now is, what do we think about that CPI number? I think it was really, really good CPI number. I think it suggests that getting inflation back to target is just a matter of having enough time, you know? Market works like the music industry. Not that well at all, really. Lies and fakers can be pumped to the top while the best of the best are ignored. You know? Or attention biases are a real thing, right? I sometimes I feel like half of the stream is complaining about humans' attention bias. is really what it is, right? What becomes the most popular on social media is not necessarily what should be the most popular on social media. Just from, like, how do you decide what is the most worthy of attention? That's a very amorphous thing. But let's just say that we put a committee together and we said these are the factors that should determine whether a piece of content is deserving of being sent out to a large audience or not. And I bet you that set of qualifications would look absolutely nothing like what actually is popular in the practical worlds, you know? And that's very true of stocks. GameStop being the most obvious attention bias. Well, in GameStop, there was a short squeeze potential there, But the underlying theory behind the whole GameStop thing, that the new CEO of GameStop had some big ideas for them and they were going to really turn that company around and save them, was completely wrong. It was completely wrong. And they got the short squeeze that they wanted and got all of this money and funding. And did they actually use it to turn the company around? No, they just sold shares on you and the CEO made himself rich at everybody else's expense. So it was actually like Deep Fucking Value's like original thesis was dead wrong, completely wrong. And then people continue to pay attention to that stock even though it's already done. Like, really, what's that company going to do? I still kind of suspect that 10 years from now, GameStop won't be around. I'm not going to short it, but I don't think they're going to be around. Doesn't make sense. But while GameStop might be the most obvious or the one that we all know about because that GameStop incident became so famous, it's not the biggest one. The biggest one is, without question, Tesla. That stock, oh my gosh. That stock is so crazy. You know, something that's really wild to me with Tesla, I tell you a story. There was this guy. I can't remember what his name was. I think it was like Raxi. Every time I see Rox Neutrino, I kind of think of him because the names kind of start the same, you know. But he was from Australia, and he had invested in Tesla, and he had gotten really lucky with Tesla. That is what he said. He said, I got really lucky with Tesla. So when I was still in the Unreal Tournament days, and Epic Games, they announced that they were making a new Unreal Tournament, which we term Unreal Tournament 4. And they said it's going to be like this community collaboration sort of a thing. And so Epic would start making the game and like committing to the GitHub, and we could all see the changes that they were making, and you could even go and build it yourself and play it. And so what Raxi did, because he's rich, and so he has the resources to, like, you know, maybe set up a couple of cloud servers, and he has the free time to go and make all of the build scripts and do all of this stuff. He basically made a thing so that you download a binary, and then he had a multiplayer server set up and everything, so you could go and play the game, which Epic did not expect them to do. Right, so we basically turned it into a multiplayer game long before Epic was ready to have anybody actually play it.
Bye.
Which was kind of problematic and kind of forced them to like do those parts, which was kind of funny. But he was able to do all of that because he was filthy rich from Tesla. Like, he was already like essentially retired before the age of 40 because of Tesla. Okay. And we're talking like 2015. Okay. So like, he was filthy rich off of Tesla before Tesla went like 100x and became this absolutely insane, crazy high flyer stock. Isn't that nuts? So if he's still around and he kept that stock, which I really think he would have, he was smart, so he you know, took profits on some of it, and then he had some of it still sitting in there. Man, I can't even imagine how much he must have now. That's crazy. It's crazy. And that's been the thing, is that even back then, Tesla was a controversial stock. It was a popular stock. people had made a lot of money from it, but there was a lot of question about, like, are they really able to accomplish what they say they're going to accomplish, and can this stock really continue going and everything? Well, in that case, it was correct, right? Because back then it was like there was only one Tesla that you could actually buy. And now there's a bunch of Teslas, and it's a popular, there's people that like Tesla cars. I don't understand them, but there are people that like Tesla cars, right? So there was reason for the stock to go up, but it's gone way, way further than you could ever justify from like the car sales. And frankly, I kind of even question, is it really reasonable? Even if you say like autonomous driving becomes a thing, or their mechanical robots become a thing, is their valuation justified? I really don't think that it is, because there's competition in those spaces. Like, part of the reason they're pivoting to humanoid robots is because other people are kind of beating them to the self-driving car thing, right? But what's really going on is this whole time, Elon Musk, he's a nerd. He understands the internet and internet discourse, and I think to some extent he understands the whole trolling and people flipping out and all that. And he's totally played it to Tesla's advantage. And so Tesla ends up being the most popular stock because it's the most popular stock and people keep talking about it, and that makes it more popular. And that's why Tesla is priced the way that it is, and not because of the fundamentals. Let's see here. Talking about automobiles, Mazda just released a big statement and show on the new hybrid Mazda with a rotary engine. Some exciting. Oh yeah, a rotary hybrid would be very interesting indeed. I kind of think that I need to buy a new car. Have I not? I haven't told you guys about this, have I? I want to hear that motor. Yeah, rotary hybrid might be really weird. But when you get into this electrical stuff, I mean, I think that's why Mazda is kind of starting to go back into the rotary engines, not just because people have nostalgia for it or it's a cool thing. There's maybe some reason to believe that rotary might fit in with the hybrid and or electric car paradigm better. I don't know. But I've kind of been thinking, if I buy a new car, well, not thinking, I've been heavily leaning towards buying a Mazda, actually. Heavily leaning towards buying a Mazda. Because, well, first of all, my family always had Mazdas. When I was a kid, I always had a Mazda. This Acura that I have, it was basically the only car I've ever owned that wasn't an Acura. So... but I was, when I took it in for an oil change last time, the car dealership said that the timing belt is getting old and that I should really be exchanging the timing belt. And then they pointed out a bunch of other different things that were wrong with the car. It's kind of like the timing belt is kind of like, you really need to do that one, you know? And another thing was that the brakes were worn and the rotors were kind of going bad. So that's maybe another one that you probably want to fix if you're going to be driving it. Although I don't notice that, so I'm kind of a little bit, okay. There are some other things that they pointed out. And I know that you usually don't get the best prices with the dealership. So I took it to another shop, right? And had them look at it. One of the things that the dealership said was that it needed like new valves and stuff like that. So I told the new shop that, and they have a really good like the rundown of like the car and like pictures of everything and all that. Actually, I can show you the pictures if you guys really want. But they were saying, oh, you know, I don't know what they were referring to with the valves or anything. But then eventually they did go, oh, actually, there is an oil leak here. there is an oil leak, and basically you have to replace like the entire engine plumbing or something like that. And when all was said and done, like all of the work that the shop said that I should do to the car came out to $15,000. $15,000. Like I don't think I'm gonna spend $15,000 on a car that I could probably get $1,000 for on trade-in, because that's like a car payment. I could just buy a newer car and be paying the same amount, right? So there's still this question of like, should I fix the car? How bad is it? Maybe we can just fix some of those things and the car will last for a year or two, and that's enough to justify it. It is. Oh no, absolutely, you're correct, Paul. Let me see if I can show you. Actually, you know what? I don't really think that I can show you the exact images because, you know, I don't want to like show the name of the dealer and all that sort of stuff. I had a picture of it though. Let me see. Let me pull the picture up on my phone. There it is. Okay, so they were saying, the crankshaft main oil seal, $55 in parts, $3,606 in labor. And that was the part that had me like, whoa. So they have a picture, I think, but I can't really tell anything from the picture. So I don't know if I showed you the picture that you would be like, oh yeah, like you really need to replace that or not, right? But that was the part that right away I'm like, that does sound like a major thing to change that would definitely affect that car's ability to keep going for a year or two. And the labor is so much. Is that alone? Let's see here. Nah, F that. It's called a free oil change. When 1 quart of oil leaks out over a month or so, you add a quart over 6 months. It's a total oil change. Okay. So that I could buy that. It's behind the transmission. That's why it's so much labor. Yeah, exactly. It was like, that just sounds like too big of a thing. Okay. They want to do engine compression testing with spark plug replacement. Oh, right. Yeah. So they want to replace the spark plugs, which was another thing the dealership noticed. That the spark plugs were like basically past their... I don't think they were saying there was anything objectively wrong with them, but just that they were past their expiration date, essentially. So that one I can probably not do, right? Timing belt with front camshaft seal, camshaft sprocket, timing belt tensioner, and water pump. So that's the part that I'm really sure that I have to do. And that was $489 in parts and $2,000 in labor, which matched really closely to what the dealership gave me. Right? There's some of these other things like cooling system, power flash, steam, clean engine. Okay, disc rotor. The parts and labor on that aren't so bad. That one together is about $600. Right? Now, there's some other parts that I think I knew about, But I do just kind of wonder. You need a backyard mechanic? Yeah, probably. Okay, control arm, strut assembly, stabilizer bar end link, strut. Like all of those things. The strut assembly is $1,000. The strut is $1,300. I knew that basically the suspension on the car was shot. I knew that part. Like if anybody else is sitting in the car with me, I'm kind of like, I'm gonna bottom out here, right? 6-figure bro drives a straight up jalopy. So here's the thing though, like I really like that car. I really like that car, and I really am worried that if I go and I buy a new car, that it won't be nearly as good as this one. Because, like, first of all, they pussified everything. So I don't think that I would end up getting, another 6-cylinder like the Acura is. And then the Acura has the technology package on it, so the sound system is really good. And every car that I've kind of looked at that, and then I look up, like, what's the sound system like, even if you go to the really nice premium one. And it's like, maybe not that good. And then what you have to pay for, like, the upgraded interior is kind of crazy. And then you add on top of that basically, like, now, buying a used car is almost as much as buying a new car. So I'm like looking at all of this, and I'm like, I'm gonna end up paying like over $500 a month for a new car, and it's not gonna be as good as my Acura. That's what I think. So that's why I've kind of been hesitant to do it. We're about to sell my wife's dad's 2020 Kia Sportage to Carvana, and they're giving us 14.4K. Oh, right. Well, this is a 2009, so... Bro drives a bigger wreck than I did making 5.25. Dude, oh, you know what I'm just realizing? This is so funny. I bought the car for $15,000. I bought the car for $15,000 in 2015. So they want to do more maintenance on the car than I originally bought it for. Wow. Okay, don't forget Paul's comments up here. You need a backyard mechanic struts. Our front suspension control arms does what it sounds like. I don't remember the rest, so a chunk of that is bearings could be replaced, but shops will do parts as long as vehicle mounts for the struts aren't bad. Them going bad will just give you crazy bouncy ride for a while. Yes, lots of fun. So that can be ignored for now, for sure, unless it rides crappy. Yeah, we're about to sell my wife's dad's 2020 Kia Sportage to Carvana. They're giving us 14.4K. Okay. Hi, Paul. I'm a Paul. No, not me, Paul. I see how that happened. Paul call? Oh, I see. Wait, did he have a comment that I missed? Is that what you're saying? Oh, okay. I know you're talking about cars, but can you show me the book? Yeah. Trades, Quotes, and Prices. Financial Markets Under the Microscope by Jean-Philippe Bouchot. Let me tell you something. Because this is one of those things I'm having this back and forth with this guy on TikTok. Sometimes I'm like really argumentative and like I really want to like fight with somebody. I'm really interested in what this guy has to say because it sounds like he knows some stuff. In the end, I am just a retail guy that happens to be like the one influencer out there that knows this stuff. I'm not the expert. If there's somebody out there that you know should be the expert and you should really listen to, it's Jean-Philippe. If you see, you can follow him on LinkedIn. If Jean-Philippe says something that contradicts what I say, I would believe Jean-Philippe, right? And the reason that book is good is because it is essentially a summary of all of the empirical research, particularly on like order flow and market microstructure, which is kind of our specialty, for the last 40 years. So like when you understand all of that stuff, basically he gives you the context that you need to be able to read more recent studies. So that's why I say you start, that's kind of the entry point. And then you can go and read studies on archive.org or whatever other kind of place you're finding studies on. Right? What is the most efficient way to identify a trend? Well, so, I mean, that's kind of the thing, is that by the time the data clearly shows that there's a trend, at least on intraday trades, by the time that the market shows that there's a real trend going on, it's basically already too late. Because these guys, you think about it, like it's a large meta order, right? So some big guy is buying it all up, moving it up. We don't know why he's trading it, but his orders have impact. There's a large meta order going out there. Now, he doesn't want you to know that he's going to buy a ton of it, right? Why? Because then you would front run him, raise the price on him, and he wouldn't get as good of a price. So what does he do? He wants to buy up as much of it as he can really quickly before you realize what's going on. And kind of what they do is they'll buy up a ton of it. And then when you realize that there's a trend, that you get in, and then they pull back on how much they're executing. And so price just kind of gets stuck in this spot. And it goes back and forth there for forever. And while it's kind of going in that spot, he's still buying, but just really, really slowly. And what's happening to you? You get frustrated and you sell to him, right? And then once he's played that one out as much as it can, then he pushes that up again. And then by the time you realize that there's another leg, it's already over, right? This is the problem with the trend. From the data perspective, is it different if you're trading momentum on daily bars? Okay, because you can catch winners that are so much larger. But on an intraday basis, like the momentum thing doesn't work, because by the time you realize that the trend is there, it's already too late. Just from the data, at least. Okay, so what do? You have to know that the trend is coming. That's why we look at everything that we know about the market, the informational inefficiencies that we have, and what flows those might predict. Then we add all of those flows together to see if there is a large imbalance between the people that want to buy and the people that want to sell that day. And if there's a really big one, like if I come through all of this and I say, maybe on a different day, we would say, well, that was such a big change in CPI. I think that we're going to have a net change of 50,000 contracts in ZN. So then I'm going to buy it as early as I can before I really start seeing it trending. And, I should catch a few ticks on that initial trade. And then, it'll go through that flat period. And there I know what's going on, so I can just hold it. And then the second leg will come out, right? And I'm not using the data to predict any of that necessarily. I know what they're going to do, right? You have to predict what other players are going to do before they do it. Now, watching the order flow and the DOM and all of that is just kind of like me verifying, is it doing what I predicted it's going to do? Is everything kind of in line? Maybe it goes up and I say, yeah, it's going up, but not because of why I thought it would. There was something else, some correlation that I wasn't expecting. And that kind of makes me think maybe I was wrong about that imbalance. I'll take the trade off earlier. Things like that. Okay. So that's how you have to identify a trend. Okay. But there are some technical things you can look at that kind of help a little bit, right? And the thing that you want to see on this kind of a trend that we're talking about is high autocorrelation in the order flow. So autocorrelation means that the data series predicts itself, right? So a perfectly autocorrelated data series would be a straight diagonal line like this, okay? It's just a consistent slope. You look at what the change was before, and that will continue to be the change, okay? So the more that a chart looks like a straight sloping line in one direction, it could be down, right? The more autocorrelated it is, okay? Something like this has zero autocorrelation. It's just going sideways, right? So one of the ways that we kind of say, does this thing predict this thing, is it's called R. Like R squared is kind of a measure of how well does this factor predict this other factor. So if you're doing like backtest in NinjaTrader, and there's a thing that says R squared, that's basically saying, like, how well did my model predict the actual behavior of the market while I was in a trade, essentially. So that's a really good indication in your backtester of whether your strategy is really picking up on something, or sometimes it's profitable and you were just lucky, then R squared would be really low, right? Okay. But NinjaTrader also has an R squared indicator. R squared indicator, which basically is just measuring how auto-correlated a stock is. So if it's 1, then that means that it's doing this. And if it's 0, it means that it's doing this. Okay. So if you take cumulative delta and you run R squared on top of cumulative delta, when you're getting an R squared of close to 1, that is a very strong indication that some sort of large meta order is being executed in the market, especially in the treasury markets or more pure markets. There's more noise in S&P 500, so you're not going to see that as much. But, in the treasuries, we look at just like right now, there was a period there where cumulative delta was a really clean straight line, right? Okay, so you can run R squared on it. But again, that's the thing, is that when R squared gets to like that 0.8, that usually tends to be where the trend stops and pauses, right? As soon as it reaches this threshold that is like, you can be certain that that's really what's going on, that's right about where it stops, because the market is very statistically efficient. So the answer is, there are some things that can kind of help you identify trends. If you are ever in a trade and it's like, oh, you know what? I bought this without realizing that it's been trending down all day. What was I thinking? Trading against the trend. Maybe add a moving average and ask yourself, is the moving average moving up or down before I take a trade? I don't know. But the real answer here is you need to predict trends, not just follow trends. You see? Or let me take a step back and let me try and approach this from a more philosophical perspective. Okay, trading is not about following other people. Everybody seems to think that trading is look at what everybody else is doing and then do the same thing that they're doing. That is not what trading is about. If you do that, you will probably lose money. The sheep get slaughtered. You want to predict what the other people are going to do before they do it. You're predicting the crowd, not following the crowd. Can you predict trends? Yes, you can. Especially the really strong ones. Every once in a while, there'll be a freak trend that nobody expects. That, they're are hard to predict. Okay, but a lot of the really good trends are things that there's a piece of news or there was a rebalancing. Like, you can kind of look at it and go through all your analysis and see that, oh yeah, there was, based on the information that we had, there was very likely to be a really strong imbalance that day, and there was. How is order flow applied to swing trading? Okay, so the higher of a time frame you get out, I would say the less applicable a lot of the things that at least we're using in order flow apply. But there is kind of higher time frame analysis of order flow, where again you're doing the same thing. You're looking at, okay, what are all of the CTAs going to do? What is the end of month rebalancing going to do? And on top of, there's a structural change in this commodity or whatever it is, right? That's moving it, and you're taking a swing trade, right? So like that kind of order flow analysis, you can perform on higher time frames. But I would say that is a very, very different thing from looking at changes in the market depth and the market orders and all of that sort of stuff, right? So at that point, I'm not even sure if you call it order flow. Okay, Andre says, on intraday, you might want to look for mean reversion most of the times when there's no impactful information. Yeah, that's true. I have always been more of the trend trader, and it's always frustrated me because on a day trading basis, there's more mean reversion than there is trend. And I think that I got pretty good at identifying when there's going to be a trend and getting into it early and just catching those little moves. But I think that our understanding of volatility has kind of helped us identify locations where you might see mean reversion a little bit easier. And when we combine that with the order flow, that seems to have gone really well. We've gotten a really high hit rate with that in November and December. So I'll see how it goes next year. But you're right. The if you're day trading, mean reversion is a better game. On the same side, if you really, really want to catch trends, it's probably better to trade the equity indexes because the trends that you get are much larger, relatively speaking. But those trends are also harder to predict. So what you gonna do? So back to the car. I'm still kind of thinking I could replace the timing belts and replace the motors and the brakes. Would that last a year or two? Because basically, to justify it, I would have to spend less than I would if I would on a car payment, essentially. Right? Oh, there's another piece of information I left out. I basically drive it for 2 hours a day. Right. So with me driving it 2 hours a day every day, do we think that that would still last that long? Or do I need to replace the oil seal? What was it? What was it called again? Or do I really need to replace the crankshaft main oil seal for it to really last 2 years? Because once I add that oil seal on it, really hard to justify the cost. Timing is good for reliability. Well, yeah, I mean, the thing I'm worried about there, maybe this worry is not justified, but they basically told me if I don't replace that and the timing belt breaks while I'm driving it, that it could seize the engine, and then the car would just be completely totaled. Brakes are duh, the crankshaft main seal isn't that important as long as you maintain oil levels. It leaks slow and will continue to leak slow. You just refill oil. Okay. But at the same time, from what you guys all just said, it also does kind of sound like you all would just buy a new car, because I should have the ability to buy a new car, right? So there's another factor in here, which is like when I told my wife, think we should just buy a new car, she did not react very well to that at all. Now, I think part of it is that we really didn't like that when I got a new job last time. Well, no, every time there's kind of been like a, here's a certain big purchase that we do need to make, and we can afford it, so I guess we should just do it. And then when you're unemployed, it's not so fun, right? So she kind of is traumatized from that and doesn't want to do that. And then on top of that, it's like probably good chance that we would be spending more on this than we spent on the van. So it's like, well, why do you get this nice car? Resources are not being expended completely for me, you know? Your rear main seal will not suddenly break or burst off. It will just leak. If it suddenly breaks or bursts off, nothing you could have done would have prevented it or stopped it. See, I'm kind of worried that this would be the analysis though, because it's still like really close. Like it kind of suggests that yes, you could do that work and get away with it. You could do that, but you just don't want to, right? Because honestly, if I'm going to be in it 2 hours a day, well, I don't know. I enjoy it. I really like the way that the car is right now. So maybe putting that a little bit. Yeah. There's actually two other things that they didn't see or list that actually I think I have to take care of too. One is that the right mirror is kind of broken. And another one is that the front left headlight is sometimes turns off. So like I have fog lights, so I think I'm okay. But like the igniter on that headlight needs to be changed, and that apparently is expensive too. But I don't know. Here, what I'm going to do, because I basically get the next 2 weeks off, paid holiday. So I'm going to go to the Mazda dealership and see if, because of the end of the year, if they have a really good deal for me. Because maybe they have a deal that's good enough that I say, yeah, and it would have to be like I think it would need to be one of their cheaper models, like maybe a CX-30, so a hybrid, 4-wheel drive hybrid, but on the cheaper, smaller side, and with the nice package, so that I still get the good sound system and everything. And if they have a good deal on it, then maybe it just makes sense to do that. So we'll talk to them next week and see what happens. Is trading your full-time job? No. And honestly, having trading as a full-time job outside of like for a bank is frankly a nightmare in my opinion. I don't understand why everybody seems to think that that's what they want to do. It's inconsistent income. It's a very difficult. Market can change on you and then it stops working. It's just it's a shitty dream. No offense, but I think you can set your there are better places to set your sights on, right? If you like trading, then by all means trade, but do it as a side gig, right? Do it as a side gig. Have a day job, do your day trading, and have your own kind of side business too. Do all three. That's a much better way of going about it than like just dumping everything into the day trading box and hoping that that one works out. For the repair prices, Euro coded, get 3. Also, don't remind the dealership it needs work. Yeah. If you can manage to get an income stream that you can generate good enough passive profits, maybe interest rates from bonds or a huge investment in high yielding stocks, full-time trading would be okay. Yeah, you know, but like this is the thing that I think is so weird about the full-time day trading dream is like, if you had that much money, would you really just like stick it all in there for a passive income stream and then get, you know, juicy day trading profits on top of that? That's not what I would do. I would be taking that nice chunk of change and like getting real yield from it and like investing in small businesses and stuff. I would be doing private equity kind of stuff at that point, you know? Like yeah, it's the same way. I would get bored and risk more. Yes. So really, when it comes down to it, if you think about it, the day trading dream that all retail traders are chasing really is be a degenerate gambler and hit it big once. Which, okay, you can do that. But if that's what you're doing, when you hit it big, you stop, right? That's the other one. Is I see these people, they like make $1 million from day trading and then they blow it all. And it's like, no. You did it. You caught the big winner. You made the $1 million. Now you stop. Or you start, you put that money away. You start other businesses. You do all of these other things. Are we chasing the dragon? See, for me, I would like more income. I would. Not because I want to be rich and to show everybody how rich I am. I think that if I had more income, I would be really, really nervous about everybody seeing that I have more income and reacting to that, because it's negative attention that comes from that, right? And I don't want more income because I just want to live this more lavish lifestyle sort of a thing. that there's not really a ton of, I am able to buy the little things that I want and I'm interested in. And in fact, what I have to do is I have to like make a list of all of the things and like spread them out. Because if I just bought them all at once, then I would be like, oh, okay. Oh, now what am I going to, like I would be bored again. So you have to like space it out. You do it one a quarter or whatever, one big thing a quarter. And then you can do that for the whole quarter. And by the time you're bored with that, then you do the next one. And, that's how you avoid the Colosseum syndrome sort of a thing. Right. So that's not why I want the more money. I want the more money because there are things that I want to do that require the money. I want to be more involved in a small business. I want to be involved in having employees. I want to learn how to make bigger, more strategic decisions, right? So what I want to do, and the things that I want to do, I think to most people would consider more work, right? That's why I want it. So when you really kind of get everything, your ducks in a row, and what is it that you really want to do, the long-term day trading goal doesn't really make sense. So then you might ask, well, but then why do you still day trade, Seth? Well, part of it is because I love it so much and I just can't give it up. I just love it too much. But the other thing is that I have learned some things from day trading that I think society would benefit greatly if everybody else knew them too. And so I want to, day trading is a really good vehicle to teach those things. It's probably the best way. How I learned it is probably the best way for people to learn it. So I do it so that more people will learn it. I think there's this thing, I used to be of the opinion, don't talk about my channel because we have a certain edge and we don't want that edge to go away. And now I feel, well, we have a certain edge, it's more informational. And even if the channel got really, really popular, I don't think that most people would be able to duplicate that edge. So I'm not concerned about the edge going away. And I do want as many people to come across the channel and watch the videos as possible so that they can learn these things about markets and so that people can understand the markets aren't informationally efficient and that very often we are making decisions based on whether the market will like it or not because we assume that the market is correct about everything. And what we're actually doing is just kind of leading ourselves down the pathway to serfdom. We are slaves, not to other people, but to the market. The market is a tool that's supposed to serve us. And more and more I'm seeing that that's not what's happening. And so it's important that we get our message out. Please tell people about the channel and have them watch those videos, especially the ones about like market inelasticity and stuff. Because I really think if these were concepts that were more generally known by the public, that it would benefit our society greatly. I want more people to see it. And then if we were more successful with it, then I would do all of those things. I would turn it into more of a business and just spend more time on the business. Not because I hate what I'm doing. I think that's part of it is that a lot of people, they just don't like their day job. To me, my day job is like playing, right? It's not real work. I have to have something that's more hardcore to be real work to feel like I'm doing work, which is maybe why I do a lot of the other things I do. But okay, you know what? You guys had a lot of good comments in there, but it is time for me to get going. So we got one more day before the break. So I will see you guys tomorrow. In the meantime, stay excellent.